Does it make sense to you? Stocks at a new record, bonds sell off. I mean, it's not exactly the playbook you'd expect to see after elevated supercore.
That's right. We think that yesterday's CPI does keep the Fed on track to start easing in June. Our economists still think that the Fed will ease 75 basis points total over the course of this year, but it's going to be a relatively slow cycle. One of the risks that they do face is from still very easy financial conditions. Fed officials haven't talked much about this, but you would imagine that easy financial conditions should be boosting consumer sentiment, and that might help drive spending. And if that's the case, there are risks still somewhat sticky inflation. Yes, we did see core services inflation come down a bit. However, that was offset by a bit of an uptick in goods inflation yesterday. And the Fed needs to be wondering, is the end of goods disinflation in? And how much might this easing of financial conditions be supporting consumer spending? Right now, we still think that the 75 basis points of total cuts from the Fed makes sense, but they still need likely additional confidence to proceed in that direction. And we don't know that yesterday's inflation report necessarily sounded the all clear quite yet.
Well, here's the question mark. If financial conditions are still easy and they get easier with a rally, and maybe it helps some that Bitcoin's also at a record with more to spend, the economy is doing okay. Why cut it all at this point? Why cut it all this year?
Well, the Fed's answer would be because they do not want financial conditions or the setting of monetary policy to be overly restrictive and generate an unnecessary economic slowdown. However, they're probably asking themselves as well, are rates really as restrictive as we thought they might be? Certainly financial conditions don't tell that. The labor market still seems very robust. Inflation is not exactly falling as rapidly as they had hoped. And so I think that's a very natural question for them. Based upon what they've seen right now, it's probably not enough to change the game plan, so to speak. But this will certainly be something that the rates market is watching very, very closely next week when the Fed meets and updates their economic projections in the dot plot. If the Fed were to show only 2 cuts next year instead of 3, that would be seen as very, very hawkish by the rates market. And that would probably help offset some of the easing of financial conditions. That is not our base case at this point in time, but that is certainly the market's risk case. And it's a question that the market's going to likely continue to ask into the Fed meeting next week.